Okay, welcome back. We're diving deep today, looking at a bunch of source material you sent over about high-frequency trading, HFTs, and algorithmic trading.
Right. And crucially, how traders actually use specific order flow info, things like market depth, the order book, and trade execution data to make decisions.
Yeah, because there's so much noise out there, isn't there? About the algos. Lots of hype, sometimes maybe a bit of fear, too.
Oh, definitely. You hear people blaming algos for everything, the algos took me out or they're manipulating the market.
It paints this picture of these, like, invisible, super intelligent forces actively trading against individual traders.
Exactly. And, well, it's worth pointing out, sometimes that narrative gets pushed by folks selling software or maybe education packages, right?
Mm-hmm. So our mission here, using insights from someone actually in the industry trading this stuff, is to peel back those layers.
To really understand who's on the other side of your trade, especially if you're in futures or equities, these really dynamic markets.
And the perspective we're getting is fascinating. It's from someone who trades based on understanding this stuff, but also describes themselves as pretty risk averse. A bit of a wimp, I think was the quote.
Yeah, which is great because it means the focus isn't on massive risk-taking, it's on managing risk and using that order flow understanding to, well, try and stay on the right side of things.
Okay, so let's jump right in. First things first, let's tackle some of those common myths about HFTs pushing markets around.
Right. The popular idea is often that HFT firms are the ones causing big moves, pushing prices up or down deliberately.
Like taking the market to VWAP or something?
Yeah, that kind of thing. But the industry insight suggests it's often the other way around. HFTs actually tend to benefit from volatility that's already happening.
So, like, if the market's already swinging wildly up and down with high volume, that's when they do well.
Exactly. Our source pointed to a Wall Street Journal piece saying exactly that. They thrive on the movement. They aren't necessarily the ones starting the big directional pushes.
That's a really key difference.
It is. And a huge part of what many HFTs actually do is market making, providing liquidity.
Meaning they're putting orders out there on both the buy side, the bid, and the sell side, the offer.
Precisely. Just sitting there offering to trade, which is a very different game. Different risk, different timing, different impact than trying to actively force price somewhere.
And I think that's where retail traders, maybe folks like us listening, get confused. We tend to trade directionally, right? Buy low, sell high.
We assume HFTs must be doing the same thing, just, way faster.
Yeah.
Hmm.
But the source describes a typical HFT strategy that sounds completely different, super low risk on each trade.
Incredibly low risk. Imagine you put in a limit order to buy, and your plan is to sell it just one tick higher. Your
Yeah.
stop loss, maybe just break even if you get filled.
One tick profit target, break even stop. That's tight.
Super tight.
Yeah.
And they might do this, say, 25,000 times a day, maybe just 5 contracts at a time. The goal isn't a big win, it's just getting filled at the bid and instantly trying to scratch it or grab that single tick at the offer.
25,000 times a day. Wow.
And here's the kicker, the really surprising bit. Even if you were wrong 90% of the time doing that.
90%.
Yeah, getting stopped out of break even most of the time.
Mm.
You could still potentially make something like $130,000 a day.
Get out. How?
Because the few times you do get that one tick, the reward compared to the risk, which is essentially zero if you scratch, is massive over that many trades. It's not about being right on direction. It's frequency, tiny risk, and that favorable skew.
That completely flips the script on what success looks like for them. It's not prediction, it's execution on tiny edges.
Exactly. And there are incentives too, right?
Yeah.
Volume discounts from the exchanges, like the CME. Our source mentions getting down to maybe 20 cents per round turn if you're trading, say, 135,000 contracts a day.
So the cost per trade becomes almost nothing, encouraging that high frequency.
Makes sense, doesn't it? Good for the exchange, good for liquidity, in theory.
Okay, so if they're mostly market making, grabbing tiny edges, what are some of these specific strategies they use? You mentioned being top of the book.
Right. Getting a good queue position. That's all about being first in line in the order book at the best bid or the best offer currently available.
So if someone comes in with a market order, just wants to sell right now, and you're the first buy order there, you get filled.
That's the goal. You get filled by that incoming market order, and then you immediately try to flip it for that one tick profit. Or, worst case, just get out at the same price, break even.
Offers amazing risk reward per trade. Doesn't need a high win rate.
Not at all.
Yeah.
But it demands incredible speed, obviously. And you need to be smart about when you put that order out, have the capital ready, and, crucially, be able to cancel that order instantly if things look dicey.
Or scratch the trade if you get filled and suddenly don't like it.
Exactly. Which brings us to sweep risk.
Right, define that quickly.
Sweep risk is just the danger that your limit order, your bid to buy, say, gets overwhelmed. Aggressive market orders come flying in and push the price right through your level before you can cancel or react.
So you get filled, but the market's already moved against you by a tick or more. Instant loss.
That's it. And HFTs obviously want to avoid that at all costs. Which leads to some controversial tactics.
Like paying for order flow. I think the source mentioned this mainly for U.S. stocks.
Yes, particularly on exchanges like NASDAQ. It's where brokers don't send your market order straight to the exchange. Instead, they sell it to an HFT firm who bids for it.
So the HFT sees your order before it hits the public market.
For a fraction of a second, yes. The source used the TD Ameritrade example, citing a report that firms like Citadel and Knight bought nearly 48% of their customer market orders.
Wow. That gives them a tiny information edge.
A crucial edge. It allows them, potentially, to see if incoming flow looks toxic.
Toxic order flow sounds bad. What does it really mean?
Our source thinks this might become a retail buzzword, but really, it just means order flow that looks like it might sweep their bid or offer in the next microsecond. It's a risk of a one-tick move against them right now.
Okay, so it's not predicting a big trend change, just immediate danger to their tiny position.
Exactly. And seeing that allows them to quickly cancel their resting orders or scratch a trade to avoid getting swept. Well, our source described it as not a million miles away from front-running. Understandably unpopular.
Yeah, you can see why. It feels like they're using information others don't have.
It skirts that line, definitely. Now let's talk about that big statistic you always hear. 80% of all trading is algorithmic.
Yeah, that sounds huge. Is it misleading?
Our source argues yes, it's often used sensationally. First, that percentage isn't the same across all markets or all the time. And more importantly, doesn't mean 80% of volume is algos trying to push prices directionally.
How do we know that?
Well, think about that Knight Capital blow-up in 2012.
Oh, right, where they lost hundreds of millions in minutes.
Exactly. They were responsible for something like 11% of all U.S. stock volume back then, when their software glitch caused them to lose $440 million in 45 minutes.
Which is insane, like $172,000 a second.
Right. The key point our source makes is that the glitch was in their market-making software, not in some aggressive directional prediction engine. It highlights their primary role.
So even that huge chunk of algo volume was largely about providing liquidity, not driving trends.
That's the argument. And despite the controversies, that activity does provide benefits, right? It adds liquidity, makes it easier for everyone else to trade, and generally narrows the bid-ask spread, which lowers costs for all of us.
But the source also calls them fair weather market makers. What's the catch?
Unlike the old designated market makers, the DMMs on the exchange floors,
The ones in the jackets.
yeah, those guys, they had an obligation to provide liquidity to quote prices on both sides, even when the market was crashing. It was risky. Many went bankrupt in '87 because of it.
HFTs don't have that obligation.
Nope, not at all. So when things get really volatile, the source mentioned historically, when the VIX index gets above maybe 24 HFTs can just vanish, pull all our
I'm
orders
going to step away.
instantly. And when that liquidity suddenly disappears, it can actually make market swings worse.
Price gaps happen because there are suddenly no buyers or sellers there.
Ah, okay. So they help in calm markets, but can amplify stress in volatile ones by withdrawing.
That's the potential downside highlighted. Now, another big slice of algorithmic trading is arbitrage. Pure arbitrage.
Just exploiting tiny price differences between related things.
Exactly. Like the difference between the S&P 500 futures contract, the ES, and the actual basket of stocks it represents, if one gets slightly out of line.
An algo buys the cheap one, sells the expensive one, locks in a tiny profit.
Bingo. Theoretically, very low risk. And it helps keep markets efficient, keeps prices aligned, but competition is fierce, so those arbitrage profits get smaller and smaller as everyone races to capture them.
And the source mentioned rebate trading, too, getting paid to trade.
Yeah, basically. Some exchanges pay you a tiny fee, a rebate, if you place a limit order that adds liquidity and gets filled. Our source used the Citigroup example from 2010.
What was that? It was wild.
Yeah.
For a time, 7% of all U.S. stock market volume was trading in that one single stock. Citigroup.
Just Citigroup. Why?
HFTs chasing those liquidity rebates. Their algos were constantly posting bids and offers just inside the spread to capture the rebate when someone traded with them. It made it almost impossible for the stock price to actually move.
Because the algos were absorbing everything to get paid.
Until a reverse stock split made the trading costs higher and chased them off. But again, think about that 80% algorithmic number. 7% of total U.S. volume was just algos playing this rebate game on one stock.
Yeah, that really puts it in perspective. It's not all directional bets.
Not even close. Then you have latency arbitrage, the Flash Boys stuff.
Building super fast networks to be milliseconds faster between exchanges.
Exactly. Spending fortunes on infrastructure to exploit price differences of maybe a fraction of a cent that only exists for microseconds. Seen as basically risk-free per trade, and again, pretty close to front-running based on speed.
So market making, arbitrage, rebate chasing, latency games, it really does sound like the vast majority of HFT isn't about big directional calls.
Right. And don't forget, even the automated stop loss or take profit orders you set on your own platform, your ATM strategy, that's algorithmic too.
Huh. Good point. If the computer places my exit, I'm partly algorithmic myself.
You got it. The source says if half your orders are manual entries and half are automated exits, you're 50% algorithmic. It's not some separate alien species.
Okay, so it's a diverse landscape.
Well,
But does this mean predatory trading, the idea of algos hunting stops, is just a myth then?
no, not a myth. Our source is clear. Predatory trading is real. But it's different from the standard HFT stuff we've been talking about. It's riskier, and it's specifically designed to profit by exploiting other, usually weaker traders.
Like bluffing in poker, you said.
Yeah, it's a decent analogy. Things like spoofing, placing big fake orders you intend to cancel just to spook people into trading.
Or using iceberg orders, where you only show a small part of a huge order.
Right. Hiding your true size at a price level to quietly absorb other traders hitting your bid or offer. These aren't instantaneous microsecond plays.
They take time to work.
They have to. You need other traders to see the spoof, or to keep trading into the iceberg, to build up trapped positions you can then trade against. This takes seconds, maybe even minutes. It's not high frequency in the same way.
So it happens less often. And it's riskier for the predator, too.
Much riskier. If your bluff gets called, you can lose money. And there are regulatory risks, fines, bans. Our source suggests it's often smaller players, maybe desperate ones, who try this stuff and sometimes get caught.
Like the knitting Gupta example. Flippin'.
Yeah, that was about making the market look weak with small sell orders trying to trick others into going short.
Then suddenly buying aggressively to push the price up.
Exactly. To trigger the stops of those shorts, forcing them to buy back at a loss, which provides the liquidity for the predator to sell into and take profit.
Okay, so it exists. How do you avoid becoming a target?
The advice boils down to common sense, really. Predators are opportunists, not superheroes. They can't fight a strong, genuine market trend.
You look for weak spots.
Precisely. They're most active when the market is choppy, range-bound, lacking clear direction, or maybe stalling at a key technical level where momentum is weak. That's when manipulation is easier.
And the source made a really interesting point. They don't actually push the market very far themselves.
That's key. They manipulate the immediate environment to make other people's stops the exit for their trade.
So they lure people in, give it a small nudge, and then sell when the trapped traders are forced to liquidate.
Exactly. Entice shorts, nudge up a few ticks, sell into the ensuing stop-loss buying. The moves caused by these plays are usually small, maybe 5 or 6 ticks on the ES, according to the source, not huge trend changes.
It's about triggering that cascade of stops for their exit liquidity. And the big HFT firms, with their steady, low-risk market making,
They just don't need to take these kinds of risks. Why bother with risky, small-scale, predatory plays when you have consistent low-risk opportunities elsewhere?
right. Okay, so let's try and wrap our heads around this for the listener. That 80% algorithmic number sounds scary.
But as we've seen, it's misleading. Remember, Knight Capital, 11% of U.S. equity volume, mostly market making. Remember, Citigroup, 7% of U.S. equity volume on one stock, just chasing rebates. It's not evenly spread, and it's not all directional aggression.
And we're all partly algorithmic if we use automated exits.
Exactly. The lines are blurry. And different time frames always coexist in markets, right? Long-term investors, swing traders, day traders, scalpers, HFTs.
Each operating on their own scale.
Yeah. And maybe even providing liquidity for the time frame above them. A scalper isn't trying to hunt a day trader's stop specifically. Their activity might even tighten the spread, which helps the day trader.
So the idea that you need special software to beat these big market-moving algos, it's mostly hype.
Largely, yes. A truly market-moving algo would have to shift related markets too, which arbitrageurs would fight. And exiting a huge position without moving price against yourself is incredibly hard. Predators plot small games around stops.
And be wary of educators or articles making wild claims, algorithmic Morse code, spoofing without trading.
Our source sees that as pattern-seeking confirmation bias, like believing in Bigfoot and then seeing every blurry photo as proof. Often it's about selling you a solution to a problem you don't really have.
So to sum up this part,
Yeah.
yes, predators exist. Yes, stops get run, and that's always happened. But HFTs mainly focus on low-risk profits, not driving markets. Volatility is normal. Flash crashes. Probably HFTs pulling liquidity, getting out of the way, not pushing things down.
Exactly. So staying on the right side doesn't mean trying to out-trade a nanosecond robot. As a day trader, you're operating between the HFTs below and the bigger players above. You can try to ride the waves from longer-term money, but fighting someone for one tick is pointless. By the time you even see their trade, they're probably already flat.
Okay, that clears up a lot about HFTs. So if we're not trying to beat them at their own game, how do we use order flow information effectively as discretionary traders?
The focus shifts completely. It becomes about understanding short-term speculation. Where are other shorter-term traders placing their bets? Where are they getting trapped? Where are the potential pain points?
Because those quick intraday zigs and zags are often driven by speculators getting in, getting stopped out, changing their minds, not huge institutions piling in.
A lot of the time, yes. Big institutional flow often comes in bursts, maybe after news. Easier to see the direction then, but harder to get a good entry. On a typical day, it's the ebb and flow of speculation that creates those intraday swings. And remember, the time frames above you, the institutions, the swing traders, they set the overall turn, not the HFTs below you.
So order flow helps you map out where the speculative battles are happening, where positions are building up, and where traders might be getting stuck.
That's the core idea, seeing those areas of built-up positions, potential vulnerability. And this picture changes throughout the day.
Now, the source warned against just looking at pretty pictures, like heat maps showing depth.
Absolutely. You need to understand the data behind the visuals. The two key pieces are market depth and order execution.
Depth is the intent, the bids and offers waiting in the queue. What might happen?
Right. And execution is the reality, the trades that actually did happen, where volume printed, at what price, who was aggressive, buyer or seller.
And the source emphasized execution as maybe even more important.
Arguably, yes. Depth can be fake, it can be pulled. An iceberg order won't even show up fully in depth. Execution is history. It shows where commitment actually occurred. You need both, though current data like depth in sales, the live tape and book, and historical views, charts that accumulate volume and highlight big trades over time.
Okay, so how do you put them together? Reading depth and execution.
Think of depth as a heads up. You see a big block of offers way above the current price. Okay, potential resistance there. But you take it with a grain of salt, it could vanish.
The real test is when price gets there.
Exactly. What happens when the market trades into that depth? Does it hold firm or does it disappear? If it holds and you see significant volume trading into it, big circles appearing on your chart at that level, then that depth is likely real. Sellers are absorbing the buying pressure.
So buyers are hitting those offers, but the offers aren't going away, and lots of trades are happening there. Buyers are getting stuck.
Precisely. That's absorption. Trading imbalance is another clue. Normally, as price goes up, you expect more aggressive buyers than sellers. But if you see a huge imbalance, like way more buyers than sellers, maybe 2 to 1 or more, but the price isn't really moving up much.
Especially near a potential resistance level.
Right, that's a warning sign. It suggests the aggressive buying is being soaked up by passive sellers, just adding limit orders to the offer side. Smart money absorbing dumb money, perhaps.
Okay, so how do you use this for entry? The source said don't just jump in because you see big depth, right?
Definitely not. That's a classic trap. Predators might show fake depth to lure you in. Instead, you look for where those traders got stuck during that absorption phase. That high-volume area where buyers got soaked up by sellers, that's a zone of trapped longs.
And you look to trade against them. Enter short.
Potentially, yes. You look to enter where those stuck traders are likely to have their stops placed, just below that absorption zone. And you refine the entry by watching the live depth in sales.
Looking for.
Signs of weakness on any little bounces, are they feeble, lacking volume? And signs of momentum picking up to the downside. Is price starting to drive down towards those stops?
The source laid out 4 distinct phases of a turn in order flow. Can you recap that?
Yeah, it's like a mini narrative. 1, you see the depth peer area of interest. 2, market trades into it and the depth stays. It seems real. 3, exceptional size trades into that depth. Traders are getting stuck absorbed. 4, market pushes away from that level. Confirmation, potentially running the stops to those stuck traders, but you might miss the absolute best entry price here.
Okay, that makes sense when depth is clear. What about when turns happen without obvious big depth, like with iceberg orders?
Right, sometimes the turn is defined purely by execution. With an iceberg, you'll see the market hammering a specific price level. Lots of volume trades there, a big circle on your chart. Aggressors are heavily skewed to one side, say lots of buying. But you look at the depth on the other side, the offer side in this case, and there's nothing much visible.
But trades keep happening there, meaning someone is selling just secretly.
Exactly. It's a hidden iceberg limit order. They only show a small piece, but as buyers hit it, the seller's algo keeps refreshing the order. The source had that ES example. 870 contracts traded at 1912, but barely any offers were showing on the book. Huge hidden seller.
That happens more in thick markets like ES.
Tends to, yeah. In center markets like crude or DAX, the source mentioned absorption might happen over a range of prices rather than one specific level. The market thickens up with sell orders across several ticks before rolling over.
An opposing imbalance at highs or lows is another execution clue.
Yes. Seeing that heavy buying imbalance right at a swing high or heavy selling imbalance at a swing low helps confirm that absorption is happening and the market might be turning. These iceberg levels or high-volume absorption zones become important hidden backstops later on.
Levels that look like nothing special on a price chart but have order flow significance.
Exactly. Potential support or resistance you wouldn't see otherwise. The
Yeah.
source also drew a distinction between minor and major reversals. Minor pullbacks often just test a prior consolidation zone, maybe get stopped by an iceberg or just run out of steam reading. Lack of activity is important too. Major trend reversals are usually busier, more volume, maybe more predatory games, and might see that thickening up over several price levels.
And again, liquidity itself isn't the signal, it's the reaction to it.
Could say it better. That depth could be half an arbitrage trade. What matters is there's a hold. Does size trade there? Who's getting stuck?
Can you walk through using this for exits? The source had that crude oil example.
Right. Imagine you're long, but the trend is down, and price is approaching a known high-volume area, a point of control, at 30.35. You see sellers hammering into that level, multiple red circles, maybe iceberg signs, sellers getting absorbed by buyers there. Price bounces a tiny bit.
But then the buyers who absorbed that selling are in trouble.
Exactly. Then you watch the depth in sales, and suddenly the bids at the level just above 30.36 get eaten fast. Whoosh, they disappear. Price starts dropping through 30.35.
What's the exit signal there for your long trade?
It's seeing that momentum aggressively return to the level where you previously saw absorption, the buyers absorbing at 30.35. Those buyers are now trapped. Seeing significant size trade as price pushes back through that level confirms the breakdown. Time to get out of the long.
You exit because the level you hoped would hold where buyers stepped in is now feeling, and those buyers are likely getting stopped out.
Precisely. And that scenario also presents potential short entries, either aggressively trading the momentum break as stops get hit, or the source's preferred way, waiting for a weak, low-volume pullback into that 30.35 area where the bids got vaporized. Lack of buying interest on the pullback confirms weakness.
And context ties it all together.
Always. The source showed that ES reversal, where absorption at the high wasn't just random, it lined up with a weekly high and a prior overnight high-volume area. That confluence gives you much more confidence.
Plus checking related markets like Dow Nasdaq Q or market internals like the TIC-E.
Yeah, seeing if they confirm the pressure you're seeing in the order flow adds another layer of conviction. It's all part of building the picture.
Okay, so let's distill the key takeaways for everyone listening.
Looking at historical order flow, those charts showing volume profiles and large trades gives you extra actionable info. It helps spot trap traders and gives you concrete reference points for entries or stops.
And reading order flow isn't about finding one magic signal. It's like reading a story playing out over time, who's getting trapped, who's getting pushed out. Context is everything.
And learn to see both the obvious stuff, big volume spikes, icebergs, and the subtle stuff, like a critical lack of participation at a key level. And it takes practice, for sure.
But remember, algorithms are everywhere, but the sum of all trading sets direction. And higher time frames, the bigger money, have more weight than the HFT's scalping ticks.
So please, try not to get caught up in the algos are hunting me fear. The pros our source knows are navigating these markets effectively. Don't let the hype distract from learning sound principles like reading the tape, reading order flow.
Understanding what HFTs actually do market making, arbitrage helps demystify them. Reading order flow isn't about fighting nanosecond robots, it's about seeing the short-term speculative flow more clearly.
So we've gone beyond just blame the algos to look at the mechanics and the practical use of order flow. Here's a final thought to chew on.
Given everything we've unpacked today, how might you start looking at those minute-to-minute market movements, those wiggles on the chart, a little differently now? What story might they be telling?
It definitely takes practice, like this source suggested. Maybe start small, just focusing on the live depth in sales, getting a feel for it. If this approach resonates, maybe exploring some tools could be worthwhile.
Though, as the source admitted, this intense level of order flow analysis isn't necessarily everyone's cup of tea.
Indeed. Well, thank you for joining us for this deep dive.